Hello and welcome to this week's Australian Share Market Report. I'm Dale Gillham, the Chief Analyst at Wealth Within. Today I'm going to be talking about becoming a full-time trader, the All Ordinaries Index and our stocks of interest for this week. If you have any thoughts on trading and investing, please comment below. And remember to subscribe to our channel so you keep up to date with our latest videos. Let's get into this week's report. Newsflash, boom share market rise entices many to the stock market in the hope of finding riches. The bull market that's been unfolding has seen average individuals looking to trade the market so they can leave work and trade full time. Sound familiar? Well, I've heard it all before. Just prior to the tech wreck, the Asia crisis, the 1987 crash, the GFC, and the list goes on. There is a saying, we learn from our mistakes. But if this is true, why then do people continually make the same mistakes, believing it will be different this time? Pretty much every week I receive an all too familiar call from someone who's been trading for the past year and had made some money. Now they want to quit their job and trade FX, options, or some other highly leveraged instrument full-time in order to earn their living from trading. Generally, they tell me that other than reading a couple of books or watching YouTube videos, they have no real education in the share market, and unknown to them, they'd simply made money in a very bullish market in what could only be described as good luck and not good management. So what do you think their chances will be of becoming a successful trader if they quit their jobs and do nothing more to educate themselves? Statistically, anyone trading options has less than 5% chance of being successful long term, and in Forex, the statistics are worse. But that aside, even if they were to trade stocks, what do you think their chances would be? At best guess, anyone would say less than 50%, when in fact statistics show that it's less than 10%, if not worse. If you seriously want to become a full-time trader and replace your income, it is entirely possible. However, to achieve that, you need to follow the be, do, have principle. In order to be a full-time trader, you have to do what a full-time trader does, and then you'll have what a full-time trader has. So how can you become a full-time trader? I've been teaching and mentoring traders for over 2 decades, and in my experience it takes at least 2 to 5 years for anyone to become a full-time trader. Now this may not be what you want to hear, but facts don't lie, as the majority turn and burn, and in doing so run out of money before they get enough experience to trade well. Knowledge is everything in the context of trading. The streets are littered with would-be traders full of hope in a bull market. Yes, many can be profitable in these bull markets, mainly through sheer luck rather than good knowledge. Strong bull markets will hide mistakes in judgment and a lack of knowledge, which is why I say that unless you've been trading successfully for more than 2 years, you cannot consider yourself a trader. To be a full-time trader, you need to combine a high level of knowledge with experience in different market conditions. Without this, your probability of success over the long term is very low. You need to remember when you leave work to trade full-time, you no longer have the security and a safety net of a regular income. Therefore, your attention is directed to making quick profits from every trade to pay the bills that keep piling up. Your need for survival will result in you attempting to trade more to make up for any trading losses or your failure to meet your financial needs. The spiral of ever-increasing pressure begins, resulting in you taking higher and higher risks to get back on top, just like the gamblers do at the casino. Unfortunately, due to a lack of knowledge and experience, the majority end up broke, back at work, and severely scarred from the exercise. Being a full-time trader does not mean you work every day. It simply means that your trading is paying for your lifestyle. It is absolutely possible to achieve this if you take the right path, as you need to earn the right to make the money. Earning the right means getting the right education, not just any education. And you need to put in the time and effort to build your skill. The majority who fail do so because they attempt to earn a living from the market, doing everything on the cheap. We all know that if you do something on the cheap, the value you get is equal to what you pay. If this is the path you choose, then the lessons you will learn from the market will be very costly in both time and money. let's get into this week's stocks. Okay, on your screen right now is a monthly chart of the Australian All Ordinaries Index, and I put that one on just so you can see how it is progressing. Now, I leave this big green line on there from that low in 2009, and you can see here how it really does vibrate around that line or its momentum. And this is one of the major metrics of any market is momentum and volatility, looking at how fast it moves and how it moves in time and price. And as you can see, it's bumping its head right on that green line, as you can see right now, closing at the last Friday at 6427.8 points. So it's doing what it's supposed to do. We've had 1, 2, 3. This is the 4th month up to the end of August. That was Friday the 31st of August there we're seeing there on the screen. So it wouldn't surprise me if we do get a month down. But I want to go to the weekly chart of the All Ordinaries Index, and looking at the bar there of that 31st of August, we can see it opened at 6357. It traded right up to break through the line that I've got there at, it broke up through to 6481 before falling away later in the week to close at 6427.8 points. And I'm going to take it down onto a daily chart so you can see that. A very strong daily bar there, 35-point range closing it on its low. It will remain to be seen if it does keep moving back down. Right now we've had 3 days up. There's a bit of indecision there, but as you know, I have been expecting the market to tip over, and we can see here how that angle is still there. I mean, you're looking at a close back here a few weeks ago at 3426. We're currently at 3427. So really over the last few weeks, the market hasn't gone anywhere. So as I said, I still do think it needs to come back for 1 to 2 weeks. And because it is, as I said, it is looking at starting to find some indecision. So, but don't be surprised. So is now the time to get into the market or not? And I think now's the time to start thinking about sitting back for a little bit just to see whether it does pull back a little bit. Now reporting season has finished. The last stocks reported last week. There's only a couple of them. I'm going to go into insurance companies this week. So I'm going to bring up Australia's biggest insurance companies. First, AMP. It's one that floated way back in the late 90s, and I remember this first, when it did actually float, you can see this huge big bar here. If I can expand that out, you can see this huge big bar where it opened, and it pretty much flew up during the day and then halved in price. It flew up to $30 and then closed at $12 all in the same week. So it's quite interesting, but it's been one of those heartbreaking stocks for a lot of people that got that stock on its float that still own it, because you can see here how it does move up and down. But it's been mainly traveling down most of the time. If you look at all the times it was moving, most of its moves are downward. That said, we are finding some strong support at this point in time, and you can make some good money on this stock if you buy it at the right time. So looking at this whole history, if I use my crosshair tool, you can see here how it is finding some support around those lows back from 2002. So these lows down around here at around that $3.06 that we see there, $3.06, $3.40. Its lowest low was $2.73. Currently, as you can see there on that last bar, it's low of $3.32, closing at $3.34. So it's nearly a sort of a double bottom. If it does hold up find some support there, this could be a nice little run up because you can see here again, you can see it between that sort of $3 to $6, $7 mark. So when it does run, it will do 40, 50, 60% for you. And on a good big stock, this is quite nice if you pick a nice entry point onto it. But at this time, as I said, I don't think there's anything too much to worry about. If you're one of those long suffering shareholders of AMP, really, I don't believe it'll go below that low back from that 2003 low, that if I can get it on there, 273. I don't think it'll go below that, but it might get close. But right now now's not necessarily the time to exit for you. Now's the time to look at saying, okay, well, it's going to start moving up. Telstra was another one of those stocks that people are going, hey, I should get out of this stock. It's just gone down to where it was before. Let's just get out. And I think right now you might be exiting a little bit too soon. IAG is another interesting stock, and unlike AMP, it spends a bit more time going up. And you can see the whole history of IAG back from 2000 to more recently. It has recently come off its new all-time high back in June at $8.69, and it's pulled back for a couple of months since then to close around that what's that, $7.72 last Friday. So at this point in time, I just think it's having 1 or 2 weeks down before moving up again. I don't think there's too much to worry about it. It's been a great company to own. You know, anybody that's been on it over the last few years. I mean, if you're looking at the move there from that low there in 2015, end of 2015, pretty much where we're at now, 3 years later, September 2015, it's doubled in price in 3 years. So that's not a bad little effort. So good stock to buy, just coming off a little bit at this point in time, nothing to worry about. QBE is another one of those ones that's been a little bit of a heartbreak for a lot of people. Prior to the GFC, it was doing really, really well. You can see there September 2007, 34.53, but since then it's just been disappointing at best. And insurance companies tend to be sometimes those sorts of more volatile because obviously natural accidents, those sorts of things can see huge payouts by insurance companies. But the interesting thing to me is if you go back, this stock, if you look at it prior to these highs back here, prior to that high there in 2001, this was just a magnificent stock to own on the Australian market. And since that point in time, it really hasn't been as good a stock for a lot of Australians. But even though we did have this beautiful run from 2002 right through to 2007, it has had, you know, real hard time since then. So if I bring that across a little bit, you can see here, and I get my crosshairs again, you can see again, it's not falling really below this sort of level, that $9 type level there. So there could be a good move in this stock, because when it does move, there's 20, 30, 40% in that move. And being a big stock like this, a good big stock like this, that level is very, very strong around that sort of $9.20 to $10 in that sort of bracket there. It's very, very strong level, and I don't think it's going to fall below it. If it does, then you'd see it'd probably fall below that low in 2001. But right now, it is looking like it's going to find support and move up. So if you are a QBE shareholder, don't despair too much. If you're not, then it could be a nice little opportunity coming up. Last one I want to look at is Suncorp. Suncorp is a bank and an insurance company, but it's a bit more of an insurance company. And again, another one that very much sort of like IAG, a bit more of a smaller company, but you can see here it's very nice, very trending. Now, its all-time high was back there in 2006 before the GFC hit right down, but it is moving up quite nicely. And importantly, it's broken above that high of 1508 from 2014. And you can see here it tried through there and it got 1524. It just broke above it there, but it couldn't sustain it. Now it's broken well above it. So to me, this is now on a nice move up. So I think that high there of $21 or $21.05, that's in danger of being attacked over the coming months. So right now, this would be the pick of the insurance companies for me for something that's more of a consistent. IAG would be there, but then I wouldn't discount QBE and AMP as a nice little more, I won't say speculative buy, but I think you know what I mean by something that's come down and it could rise up quite well over the coming months. So have a good look at those. That's it for me this week on the stocks. Look forward to chatting with you next week. Take care. What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on SoundCloud and on our website. Now they're jam-packed with valuable information which will help you elevate your trading. Now if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck and good trading.